And it has. The economy is actually falling off a cliff because they probably over-tightened. So even though we kind of know things are bad, the forward-looking stuff that I look at using my kind of macro framework suggests things are going to get really quite ugly over the next 6 to 9 months. So what the Federal Reserve are doing when they raise interest rates is they're taking what's known as liquidity out of the system. So what they're saying to banks and others is we're going to allow you to have less money to use around the system. So that means it's harder for anybody to borrow money. It's got more expensive. Your mortgage has gone up. Your rent's gone up. So everybody stops spending and the economy slows down. And that brings down inflation because there's less demand for goods. But it has other effects as well. Obviously, people start becoming unemployed again, which, people were kind of saved a bit by COVID, by the stimulus checks and what happened. But this time around, there's nobody really wants to save them because the Federal Reserve has said, we actually want unemployment to rise. So they want you to lose your job. So you buy less goods, so the price of goods falls, which is kind of a bit screwy, but that's what they want. And that whole mechanism of the Federal Reserve doing this, so crypto is a function of two things: technological adoption and the macro, the liquidity that the central banks are providing. Those two things are the key drivers. So if you zoom out of a log chart of crypto that everybody always tells you to do, you can basically see things like Bitcoin go up, just up over time, and up a lot. But it's very volatile. You get these kind of big ups and downs. So the question is what drives the big up, and then what drives the ups and downs? The big up is driven by the adoption of technology. There's now 300 million people using cryptocurrencies or investing in cryptocurrencies. It's growing at about 100% a year or so. It's the fastest adoption of any technology the world has ever seen. So people are adopting this twice the speed of the internet. That's why it's been so profitable, but it's also very volatile. And it's very volatile because when the central banks remove liquidity, which they've done in 2013, 2015, and various other points, cryptocurrency collapses because there's less money around for people. And this particular example, what's just happened over the last year, is to do with the fact that most investors in crypto are actually retail investors. It's not going away. We're just in this period where it looks pretty ugly and feels pretty ugly. So these are the big pension funds and hedge funds and others. They're also struggling from lack of liquidity because their portfolios are going down from what the Federal Reserve are doing. So they have less money to put into crypto. So I spend a lot of time speaking to these big institutions and they're all ready to get involved, but they just don't have the cash right now. Much like we don't have the cash because everybody's feeling the pinch. So if everybody's feeling the pinch, it's not going to drive up the price. But once this situation eases, it'll start driving up the price. Now, there's another piece of magic that happens with crypto. Is crypto doesn't do well in inflation because of the reasons I said. But when the central banks start printing more dollars or euros or pounds or yen or whatever it is, that's called debasement of the currency, quantitative easing. And that is when crypto does really well. So one of the reasons I've been very closely following the prices in crypto recently is because as we start getting a worse and worse economy, we know eventually rate rises will give way to rate cuts. Quantitative tightening will go to quantitative easing, and those conditions are literally perfect for cryptocurrencies. But what's super powerful about crypto versus almost anything else is the fact of how it works with behavioral economics, because token systems are incentive systems by nature. So to explain it to you at a simpler level, Facebook is a viral set of products, whether it's Instagram, Facebook, WhatsApp. But we as users get to use those things, but we don't get any rewards except connecting with our friends or whatever. And the shareholders got rich as the network grew. So 3.5 billion people use Facebook technology right now. But with crypto, it's like we'd all been given Facebook shares. So imagine if every time you logged into Facebook or used Facebook, you got shares. So if you own part of the network, well, what are you going to do? You're going to tell everybody about it, which is why you get this kind of weird world of everybody shilling cryptos, because it increases the size of the network and therefore the value goes up. So it's viral by nature. It's kind of designed to be viral. So it's very difficult to stop because of the human psyche behind it. But it was the advent of Ethereum and the smart contract that was the big game changer. Because almost everything we do, including me coming on this podcast, is a contract. And they're mainly unique contracts. Everything, whether you buy a ticket for something, whether you go somewhere, almost all human activity is some form of contract. Now those can go on blockchain and be recorded. So before, if you buy a car, you have to go to the center and register it and do all of this stuff. It's a pain in the ass. But what happens is on blockchain, it can be authenticated by a distributed network of people, which means it's more secure in terms of who confirms that contract exists, and therefore it can be policed. So that opened up to things like decentralized finance. But that opens up even more, and this is the rise of Web3 suddenly, is, okay, well, this launches things like NFTs, which are non-fungible contracts, which are essentially non-fungible tokens, which are essentially smart contracts. And those smart contracts allow us to do a number of different things, whether it's attach a picture to it, artwork to it, music to it, piece of magic, and I alluded to it earlier. We know that the adoption is going up, and the adoption of a network drives up price. It's called Metcalfe's law. So here we are at the most oversold levels, almost in history of crypto. Yes, the price move has not been as big as it was in earlier stages, but the levels of how oversold it is are enormous. So here we are looking at this saying, okay, it's been driven by the macro, it's been driven by the central banks, liquidity, inflation. And our job is to look forward the next 2 years, 3 years, 5 years, and say, is this current state of affairs going to be permanent or temporary? Well, the history of economies is the business cycle goes up and down. It's cyclical. So therefore, with the cheap levels, we're kind of at key trend lines. And almost every time we get here, the crypto market 10 or 20 X's from here. Now, that's not a guarantee that it does it next time. So your risk reward is highly favorable. And you've got the shifting macro where we're going from maximum pain in the economy to starting to see the central banks change their course and start adding liquidity back because they've broken the economy. Now, you can buy it from your PayPal account. That's how I got my sister-in-law in. I'm like, here's your PayPal account,
easy.
Do this.
Yeah.
Then you need to decide, okay, how risk averse am I? Usually if you're young and you're not saving this money for a specific thing like a house, but you're saving it for your future, then you can be more aggressive with risk because you have a long time for it to realize the returns you're expecting. If you're trying to do it for a house, then don't, for goodness sake, hope that Bitcoin's going to save you for your house deposit, right? It's not going to help.
No.
So that's where you need to think about, where am I risk adverse?